But let's do one thing. Let's get straight to some numbers now. Kalpataru Power is a stock on our radar. It reported an operationally weak Q2, though the company posted a good revenue growth. Once again, the same old story. Higher input costs pushed the margins under pressure. We're joined by Amit Uplenchwar, the director at Kalpataru Power, to discuss the numbers this time around. Amit, thanks so much for joining us and happy Diwali to you. I want to first start with the operational performance because the input cost pressure has been quite severe. You know, your margins have gone from almost 13% same time last year to about 7% this quarter. Do you see more margin pressure in the second half of the year?
So Sonia, before we start, wish you also and all the viewers an outstanding Diwali and hopefully COVID-free by the time we do this interview next year at the same time. Yes, if you look at our results, let's break it down in two parts. So we've got our consolidated numbers. We've had some exceptional items because of which we had margins that optically look off. But if you see on a standalone basis, both for JMC and KPTL and on a consolidated basis, we are maybe 100 basis points off where we were previously. So I think these are exceptional one-time adjustments which have been done in order to keep our stance of a conservative accounting. And so to that extent, I think our EBITDA outlook remains, yes, under pressure. There has been commodity pressure and a lot of freight pressure for most of the companies that are in the heavy industries and the contracting space. Hopefully, if the same doesn't continue to go up further, by the year end, we should be able to weather this increase by the end of the year and stick to our guidance of, between 9 to 10% EBITDA at a consolidated.
Okay, so you're expecting maybe a recovery in the second half when it comes to your margins, 9 to 10%. You're sticking by that guidance. But can you just give us a sense in terms of what the order book is looking like for you all this quarter?
So our order book at a console level today, Ekta, is at 35,000 plus. And I'm pretty pleased because this is the highest ever order book for the Q2 that we've had in the history of our KPTL console. And that's very heartening. That gives us a 2x plus, visibility in terms of revenue already today. As everybody has seen, if you look at the macros, we are having huge upsides today. Our GST collections are very strong. Our diesel consumption is at pre-COVID levels. And a lot of the private sector capex, whether it's in metals, whether it's in oil and gas, real estate, which was subdued for a long period of time, seems to be firing on all cylinders. And it just happens to be the sectors where we are in, deeply entrenched. So I think it's exciting in terms of visibility of order book going forward as well for us.
Okay, but just coming back to the margin performance itself, Amit, you said that by year end you should be able to recover margins. Is it purely because the raw material cost pressure will abate, or are you also taking some cost cutting measures? And if yes, what kind of margins? I mean, are you looking at getting back to double-digit margins anytime soon? What could the trajectory be?
So, Sonia, you've got two questions, so I'll answer them in two parts, right? So the first is, there are, in terms of our for KPTL, a lot of our TLD, towers, etc., we've delayed with client consent wherever possible in order to mitigate the freight costs, especially to Latin America and other countries. And this is in discussions with our clients. So some of that margin which is deferred will probably come back to us by the end of this fiscal. So far as JMC is concerned, most of our contracts have passed through in terms of commodity prices, and those escalations pretty much kick in a few quarters later. So we are also hoping that some of those margins come back by way of escalation towards the end of the year. And so far as your second question is concerned on cost cutting, on the contrary, Sonia, we've got an order book which is at an all-time high. We see the future very bright in terms of capex. So we have been focusing a lot on strengthening our organization. We've had a lot of senior management hires that have happened here. In line with the promoters' ethos of high quality and focused on being a high value engineering organization, we have been also investing a lot of our capital on strengthening and expanding our engineering capability. We've almost doubled our engineering strength. We have been focusing a lot on AI, IoT, drones, and so on in terms of technology in our projects so that we get more mechanized. And I think that is giving us a cost optimization by way of a sustained effort going forward. Rather than just looking at cutting costs, which we are trying to optimize wherever we can, but the focus is to strengthen organization, be a tech-enabled company so that we can attract the new age talent, and that is where we are focusing on going forward.